If you've been following the news recently, you might have heard about a recent push from the Trump administration to include alternative investments in folks' 401k accounts. And what is an alternative investment? Put very simply, an alternative is anything that is not a traditional stock or bond market-based investment. So as an example, you might have real estate, you might have private equity or hedge funds, commodities like gold or oil, and then you could even get into collectibles. So think art, wine, certain types of watches, and one that's near and dear to my heart is collector cars. All are alternative investments because they do not track with the traditional stock and bond markets. Now, alternatives became popular because of a college endowment, particularly the Yale College Endowment. And Yale's general idea is that they want to hold a large percentage of their assets in these alternative investments. And for an endowment as large as Yale's, billions upon billions of dollars, it's an interesting case to be made, but it's one that we find is not particularly applicable to individual investors. And let me tell you why that is. So the benefits of alternatives are generally they intend to provide you a return that is not correlated with the stock market. So if the stock market's having a really crummy year, the intention is that your alternative investments are not going to be performing like the market. They might be increasing in a down market, and we'll call these uncorrelated returns. Now, the downside to an uncorrelated return is they don't track the stock market. And we know the stock market is positive for the majority of the time. So when markets are having a really good year, like we had last year, those alternative investments might be performing poorly or they might be flat. So understand there's a trade-off here. And as an example of these uncorrelated returns, coming back to my favorite example, collector cars, I've had collector cars that performed very, very well in years where the market was doing poorly. And I've got an old Jaguar right now. The stock market's doing great, but the value of this Jaguar is down from when I bought it, and I'm probably going to lose money when I go to sell it. So uncorrelated returns are both a positive and a negative. Some other things to consider about alternatives: they are oftentimes illiquid, so you cannot easily exchange your alternative investment for cash. They oftentimes come with very, very high fees. So think 2 to 3% of your investment value per year is getting eaten away by just the fees to own this particular alternative investment. Another thing to understand here is that alternatives are not revalued on an ongoing basis like you would find a stock in the stock market. You might get an updated value from your alternative once a quarter, maybe once a year. So understand you do not have visibility on how that alternative is performing on an ongoing basis. You can probably, at this point, figure out we, at our particular office, are not particular fans of alternatives. They can make sense in a very, very small number of circumstances. But what we've found over the years is that they are oftentimes sold as a cure-all in situations where they're probably not appropriate. That being said, through Wealth Enhancement Group, we do have a large menu of alternatives, and we look at these on an ongoing basis as part of our due diligence. So understand, we've got our eye on this part of the market, and it's an intentional decision for us not to include them because we just don't find that the risks are worth the reward. If you have any questions, please feel free to let us know.